Hi folks, this is Mr. Oleson. We're in Macro, Unit 4, the financial sector. And today's video is about topic 4.4, which is banking and the expansion of the money supply. And what you're going to learn about today is how banks work in the United States and how they literally create money out of thin air through the fractional reserve banking system. Modern banking is called fractional reserve banking, and that's when banks only hold a small portion of deposits in order to cover potential withdrawals, and then they loan out the rest of the money. So when you have money in your checking account, the money's not actually sitting in the bank. Most of that has been loaned out by banks. So if you open your Bank of America app right now, it may say you have $500 in your checking account. But that's not actually sitting in Bank of America's vault. The majority of that has been loaned out. Okay, and it's a really healthy system that keeps the modern economy going. Okay, however, because banks don't have all the deposits, a potential bad situation could happen if everyone went to Bank of America and said, "We want to take out our all the money in our checking account right now." Okay, and what that's called a bank run. Bank runs have been huge problems historically because of modern regulations. They're not a common issue. The last time in the U.S. that we had major bank run issues was during the 1930s and the Great Depression. A great depiction of a bank run is from the famous Christmas movie It's a Wonderful Life, and pretty famous scene in there. You can look it up on YouTube if you're interested. But thankfully, we don't have to worry about bank runs anymore because in the U.S. and in most modern economies, we have deposit insurance. So in the U.S., the FDIC insures your deposits in any account up to $250,000. So if the bank fails and is not able to pay back all of its demand deposits, the federal government will insure you and pay you back for that. Before we jump into looking at individual banks' balance sheets and how this process works, I need to explain to you the money multiplier. And when I explain this to you, I want you to be thinking about the spending multiplier and the tax multiplier when we were analyzing fiscal policy. The concept of the money multiplier is very similar. Banks have something called a required reserve ratio. And if the required reserve ratio means that for the percentage of money in checking accounts or demand deposits, what percentage of that are they required to hold in their vault? And whatever is left, they're allowed to loan out to businesses and consumers. So if the reserve ratio in the US is 10%, let's follow the process of what would happen when you make a deposit. So let's imagine you get $1,000 cash as a graduation gift from your grandparents, and you go ahead and go to your bank and you deposit that $1,000 cash into the bank. Okay. With that $1,000, the bank can do some different things with it. Because the required reserve ratio is 10%, they're required to hold on to $100 in their vault, and they can't do anything else with that because that's what the law says. That's what the reserve ratio is. Okay. However, the bank is then able to loan out $900. So, of the $1,000 that you put in your checking account, the bank lends out $900 to Bob. Okay. That $900 was part of something called their excess reserves, which was money that they were able to loan out. And they did that. And here's the key piece. When Bob takes out a loan from your bank, he's going to get a check for $900 and he's going to deposit that in his bank. So Bob goes to a different bank than you and he takes that money that he got from a loan and he deposits it in his own bank. Okay, so now Bob's bank has $900 new dollars that did not exist before. What's Bob's bank going to do with it? Well, because the required reserve ratio is 10%, Bob's bank is going to hold on to $90 and then they're able to loan out 90%, the 90% that's left. In this case, that would be $810. So let's say Jill wants to take out a loan for her business. So she goes to Bob's bank, she takes out a loan for $810, and with that $810 that she takes out from the loan, she's going to deposit in her bank. Okay, so you can see this process happen. And then if we were to go on, Jill would then deposit in her bank, and then her bank would loan out 90% of that, and so on and so on. So an initial deposit of $1,000 is literally creating money because when banks loan out money, the loan is going to show up in some other checking account, which is literally creating money out of thin air. So if that process were to continue until um, until every single dollar was reloaned out, then you would have the total change in the actual money supply. And that's the idea of the money multiplier. This is an equation that you need to remember, and it's 1 over the required reserve ratio. Okay, so put that in your notes, put a box around it. This is an equation that you need to remember. The good news is it's the same concept as the spending multiplier. The spending multiplier was 1 over the MPS, and the money multiplier is 1 over the required reserve ratio, right? And the MPS is how much people save and not respend, whereas the required reserve ratio is how much banks are required to save and not reuse by issuing loans. So let me define some terms for you, and then we're going to jump into looking at some bank balance sheets. Demand deposits are money that is deposited in a commercial bank into a checking account. Okay, and it's called a demand deposit because at any time, the household who's deposited their money there could demand payment from it. Hence the name demand deposit. When we look at the money that banks have as assets in their vaults, there's going to be something called required reserves, and that's the percent that banks are required to hold by law. They also may have some excess reserves, and that's extra cash that banks have on hand that they can loan out if they choose to. In a moment, I'll show you a balance sheet or a T-chart, and that's going to show a bank's assets and liabilities and total net worth. So it's going to give us all the financial accounting information for a bank. Okay. Let's make a connection to terms from the financial sector. When I show you a demand deposit in a second, I want you to think for a moment. Is a demand deposit an asset or is it a liability? Well, the answer is it's both. Okay. Demand deposits are liabilities for banks because it's something that they owe their demand depositors, right? So it's a liability for a bank, but it's an asset for the depositor. So for the person who put their money into their checking account, it's an asset because it's something that they own and that they can use in the future. Let's jump into actually analyzing banks. So this is your first bank balance sheet. And I want you to know that there are 2 columns. There's assets. Assets are always on the left. And there's liabilities. Liabilities are always on the right. Okay. Let's start with the liabilities. So this particular bank has $5,000 in demand deposits and $5,000 in owner's equity. The person who started this bank used $5,000 to do it, and they have that equity in the bank, and then they've collected $5,000 in demand deposits from households. So those liabilities add up to $10,000. And then what have they done with those liabilities? Well, they've issued $8,000 in loans. They have $500 in reserves, and then they've bought some treasury bonds from the government for $1,500. So those total assets also add up to $10,000. It's called a bank balance sheet because both sides always have to be balanced, right? So if we have $10,000 in assets, we must have $10,000 in liability. So that's important because as you're working through these problems, you can always make sure that you're balancing both sides, and then it'll make solving the solutions easier. For this particular bank we're looking at, if they're holding no excess reserves, in other words, their only reserves are required reserves, what is the required reserve ratio? Well, the answer is 10% or 0.1. The reason is because they have $5,000 in demand deposits and $500 in reserves, and 500 is 10% of 5,000. When we look at required reserves, it's only the proportion of the demand deposits. We ignore owner's equity or any other kind of liability in there, okay? So it's just whatever percentage of the demand deposits. So let's take a look at a different bank. Notice how we have assets and liabilities. The liabilities are $20,000 in demand deposits and $5,000 in owner's equity, which add up to $25,000. And then if we look at the assets, there's $15,000 in loans that they've loaned out to other businesses. They've bought $5,000 in treasury bonds. And then they have $3,000 in excess reserves and $2,000 in required reserves. In this particular balance sheet, the total reserves have been broken out into the subcategories of required and excess reserves. So their total reserve is $5,000, but of those $5,000, they're actually allowed to loan out right now an extra $3,000. Notice how the assets add up to $25,000, and so do the liabilities. So let's see what happens when Bob comes to this bank and deposits $1,000 into it. First, let's look at question number 1. What is the required reserve ratio? Well, if the demand deposits are $20,000 and the required reserves are $2,000, then the required reserve ratio must be 10%. Now, when Bob deposits that $1,000 into the bank, question number 2 says, will the M1 money supply increase, decrease, or stay the same? And the answer is stays the same. And that's because the M1 money supply includes currency in circulation and checkable deposits, which are demand deposits. So when he moves that money from cash to his checking account, there's no change in the money supply. However, some things are going to change for this bank. So now that Bob's put an extra $1,000 in the bank, the demand deposits for this bank are now $21,000. Okay. We added something on the liability side, so the total demand deposits now are $21,000. So we have to do the same work on the asset side to make the adjustments. Okay. Because we have $21,000 in demand deposits, our required reserves are now $2,100, and that's because 10% of $21,000 is $2,100. Our excess reserves are now $3,900. So the answer for number 4 is $3,900. And that's because we took that $1,000 that Bob deposited, we put $100 in our required reserves, and then we added the remaining $900 into our excess reserves. So our total excess reserves now are $3,900. Question 5 says, how much more can the bank initially lend out? Well, as a result of that $900 change in excess reserves, this bank can now loan out $900 new dollars. So as a result of Bob depositing $1,000 in the bank, this bank can initially lend out another $900. Question 6. What's the maximum change in the money supply from the deposit? This is where we use the money multiplier. So if the required reserve ratio is 10, the money multiplier is 1 over 0.1, so the money multiplier is 10. So we take that $900 that was created by that first loan being made, and then we multiply it by 10 to get a total change in the money supply of $9,000. Once all of this reverberates through the banking system, there will be $9,000 more dollars that did not exist before Bob deposited his $1,000. So let's take a look at the same bank from the same starting point, but this time Bob's going to withdraw $3,000 from this bank. Go ahead and try questions 1 through 4 to see if you're getting it. Pause the video and try it, and then I'll go over the answers. Question number 1. Will the M1 money supply increase, decrease, or stay the same? The answer is stay the same. Demand deposits and cash are both included in the M1 money supply, so there's no change in the money supply. Question number 2, how much are the required reserves? Okay, so we're going to mark up this table. I can't do it right now, but that's what you should be doing. Demand deposits went from $20,000 to $17,000 when Bob took his money out. So what we do on one side, we need to do on the other side. So we need to go over here to our assets and take out $3,000. We're going to take away $3,000 from the excess reserves, which means we have $2,000 in total reserves less. Now that our demand deposits are $17,000, we only need 10% for required reserves. So our new required reserves are $1,700, which is 10% of $17,000. Okay. Question number 3, how much are the excess reserves? Well, we still have $2,000 in reserves, so we keep $1,700 in required, and then we move $300 down to excess reserves. So we have $300 for excess reserves. Assume Bob burned the money. Bad idea, illegal, but Bob's going to do it anyway. What is the total change in the money supply? Well, Bob took that $3,000 and it went away. It's not going to stay in the banking system. It's going to go away. So this is where we use the money multiplier. Okay? The maximum change in the money supply is where we use the multiplier. Because the required reserve ratio is 10%, the multiplier is 10. So the maximum change in the money supply is a decrease in $30,000 because 3,000 times 10 is $30,000. The best way to learn bank balance sheets is to keep practicing these over and over and over. So we're going to do some practice together here in the slideshow, and then you're going to do more and more practice on your own. For most students, this may take a little while to click, and the best way to do that is to practice, practice, practice. Go ahead and pause the video, try this released MC question, and I'll go over the answer. Correct answer is D as in dog. D is the only statement that's true, which is that Bank B can increase its loan by $40. Let's take a look at Bank B. Their demand deposits are $600. Their actual reserves, which is their total reserves, is $100, and they've already issued loans of $500. So, if the required reserve ratio is 10% and Bank B has demand deposits of $600, that means the required reserves are $60. So they could loan out an additional $40 from their actual reserves and still meet the required reserve ratio. Here's Mitiera Bank. This is a good meat and potatoes AP Mac or FRQ bank balance sheet. I've shown you how to do these, so let's practice on your own. Go ahead and pause the video and see if you can do parts A, B, and C. Part A, what is the reserve requirement? The correct answer is 10%. Take a look at the chart. The demand deposits are 100,000 and the required reserves are 10,000. And 10,000 is 10% of 100,000. For part B, we have a withdrawal from the bank. So we are going to take out $5,000 in cash. And the question for part one is, by how much will Mitiera's bank reserves change based on Louis' withdrawal? So on our liabilities, we're going to decrease 5,000 on the right-hand side. So our demand deposits will become 95,000. And what we take away from liabilities, we must also take away from assets. So we're going to decrease our reserves by $5,000 as well. So part one, $5,000. Part two, what is the initial effect of the withdrawal on the M1 money supply? Explain. There is no effect on the M1 money supply because the M1 money supply is made up of demand deposits and cash. So the initial effect on the M1 money supply is it does not change. Part three, what's the new value of the excess reserves? The correct answer is $500. Let's figure out how we did that. When Louis withdrawed $5,000, our demand deposits became $95,000 and our required reserves became $9,500. We also subtracted already those $5,000 in excess reserves. Okay, so because we only have $9,500 in required reserves, we're able to move $500 down into our excess reserves as a result of the withdrawal. Part C, what happens to the bank if their withdrawals are greater than their excess reserves? Well, the bank usually has three options. They gave us one of them in the question. So one option would be to call loans in, which means call the investors who borrowed from them and say, sorry, we need our money back now. Okay, but they want other options than that. So it says, how can Mitiera Bank cover its required reserves? There's two regular options from this. They're going to have to borrow the money. They can borrow the money from the Federal Reserve, which is the central bank, or they can borrow money from another bank. And of course, this slide shows you the key that I just talked about for Mitiera Bank. Last practice question we're going to do together is Swell Bank. So go ahead and pause the video, take a stab at parts A through E, and then we'll go over them together. Part A, based on Swell Bank's balance sheet, calculate the required reserve ratio. Correct answer is 0.2 or 20%. The demand deposits are 10,000 and the required reserves are 2,000, which is 20%. A common mistake on this is students would include the owner's equity when they're trying to figure out required reserves. That's not what we're going to do. We're only required to have reserve ratios for demand deposits. Any other liabilities we have, which is in this case to the owner who started the bank, we do not have to keep any percentage of that liability on our books. Part B, the Federal Reserve buys $5,000 worth of bonds from Swell Bank. What will be the change in the dollar value of each of the following immediately after the purchase? Part 1, excess reserves. Okay, in this example, when we're dealing with bond purchases, we're only dealing with the asset side. This is not going to impact our demand deposits. So if the Federal Reserve comes and buys those bonds from us, our government security bonds are going to decrease by $5,000. So instead of being 7,000, our government securities quantity is going to go down to 2,000. And what did we do when we sent those bonds to the government, to the Federal Reserve? They gave us cash in exchange, right? We sold them for cash. So we're going to decrease bonds by $2,000, and then our excess reserves is going to increase by $5,000. So we now have $5,000 in cash that are part of our excess reserves, and we could loan out if we want to. So part one, increased by $5,000, and then part two does not change. The demand deposits did not change. We're only moving around the assets on the left-hand side of the balance sheet. Part C, what's the maximum change in the money supply that can change as a result of the purchase of $5,000 in bonds? This is where we use the money multiplier. When they ask about maximum change in the money supply, that means this is going to have a ripple effect throughout the economy. The required reserve ratio is 0.2, so the money multiplier is 1 over 0.2, which is 5, and $5,000 times 5 is $25,000. So part C, $25,000. Part D is jumping ahead a little bit in the curriculum. To really understand Part D, you need to understand monetary policy. Okay, but what's happening here is when the Fed is purchasing bonds, they are lowering the interest rate. So the key relationship here is a relationship between interest rates and bond prices. So the Fed purchases bonds, which lowers the interest rates, okay, which is going to increase the price of bonds in the open market. Okay, and so the answer for part D is increase, because when the Fed purchases bonds, it decreases the interest rate. And we already established before, there's an inverse relationship between interest rates and bond prices in the open market. Part D, instead of the Fed purchasing bonds, an individual puts $5,000 cash into their checking account. What's the immediate effect on the cash of the cash deposit on the M1 money supply? And the answer is nothing. There's no change to the M1 money supply because cash and demand deposits are both part of the M1 money supply. They love asking that question. As you can see, it's showing up in a lot of the practice questions. And then, of course, here's the key, so you can go over your responses to the Swellbank FRQ. Folks, thanks for listening. This is Mr. Oleson. This was AP Macro Topic 4.4. Enjoy the rest of your day.